Okay, let's get right into it. What really makes the stock price go up or down? It seems like such a simple question, right? But the answer? Well, it's one of the biggest paradoxes in finance, and I'm betting it's not what you think. So let's dive in and unpack this.
I mean, think about it. A company is absolutely crushing it. Sales are strong, profits are growing, customers are happy. Its stock should be soaring, right? But we've all seen it happen. A great company and its stock is just crashing. And on the flip side, you've got some, frankly, pretty terrible companies with stock prices that just go to the moon. So what on earth is going on here? Well, here's the uncomfortable truth, and it's the core idea we're going to unpack today. A company's performance and its stock's performance, they're two completely different things. They're driven by entirely different forces. So first up, let's tackle this central myth head-on. Why is there such a massive disconnect between what makes a good business and what makes a good stock?
You know, most of us are taught this very simple, very logical idea. If a company gets a good report card, its stock is going to do well. Makes sense. But here's the reality. The market isn't a report card. Not even close. It's a chaotic, global auction happening every single second of every single day.
And this quote just hits the nail on the head. Think about it. A report card grades what happened in the past. It's backward-looking. But an auction only cares about one thing and one thing only: what is someone willing to pay for this thing right now?
So, how does this giant global auction actually work? Well, it all boils down to two really simple forces, and one concept that's, a little bit tricky. Okay, this is it. This is the only reason a stock price ever moves. It's pure, simple supply and demand. If there are more people trying to buy than sell at a certain price, guess what? The price has to go up to tempt more sellers into the game. And if sellers just overwhelm the buyers, the price has to fall. That's it. That's the entire game right there.
So you see, it's not the company that sets the price. It's not the CEO. It's not the earnings report. It's people. It's us. It's traders, investors, and a whole lot of algorithms, all collectively deciding what a stock is worth in that exact moment, just by buying and selling.
But here's the big twist. This whole auction, it isn't based on what a company is doing today. Nope. It's based on what millions of people think it's going to do tomorrow, or next quarter, or even 10 years from now. It's a game of expectations.
Okay, this is a perfect example. So, a company has an amazing quarter. They make $1 billion in profit. That's incredible. But the market doesn't care. The stock actually falls. Why? Because investors had already priced in an expectation of $1.1 billion. Now, priced in just means that the current stock price already reflected that higher hope. So by only making $1 billion, they fell short of the expectation. The good news actually became bad news, and the stock goes down. So here's the takeaway. The market moves when reality is different from what was expected. It doesn't matter if the news is good or bad in a vacuum. What matters is, was it better or worse than what everyone was already guessing? It's all about the surprise. Okay, now let's zoom out for a second, because it's not just about individual companies and their earnings surprises. There are much bigger forces at play here, forces that can lift or sink all boats at once. So let's talk about the real heavyweight in the room. And that heavyweight has a name. Liquidity. The easiest way to think about it is just the amount of money sloshing around the global financial system. Is money cheap and easy to get your hands on, or is it expensive and tight? This one factor is a huge driver of market direction, and it's largely influenced by what central banks like the Fed decide to do. So, when money is easy, interest rates are low, borrowing is cheap, it's like a fire hose of cash gets turned on. That encourages spending and investment, and a whole lot of that cash flows right into the stock market, pushing pretty much everything up. But when money gets tight, the exact opposite happens. That fire hose gets turned off. Money gets pulled out of riskier things like stocks, and prices tend to fall, across the board. So a lot of the time, the entire market rises or falls, not because thousands of companies all magically got better or worse at the same time, but simply because the environment for money itself changed. The tide of liquidity just rose or it fell. So who's actually moving all this money around? Well, you might be surprised. While individual investors like you and me, we play a part, a mind-blowing 90% of the daily trading volume comes from massive institutions, hedge funds, and, of course, automated algorithms. Their decisions, they're the ones creating the waves. And this creates a really clear dynamic, right? The big players, the institutions, they tend to act first. They decide to pull money out of a sector or reduce their risk, and the price moves with them.
Retail investors, a lot of the time, are left reacting to waves that have already been made.
Okay, so we've got this battle of expectations going on. And on top of that, we have these huge waves of big money sloshing around. So where does all the daily news fit into this? Well, this leads to another really surprising idea about how the market works.
This is a really powerful and kind of counterintuitive idea. A lot of the time, the market is already positioned to move in a certain direction, maybe because of liquidity or sentiment. That news headline you see, it doesn't cause the move. It's just the excuse for a move that was already coiled up like a spring ready to go. The story is often just the justification we create after the price has already moved.
So instead of just asking, hey, is this a good company, maybe we should be asking a different set of questions, a new framework. Questions like, what does the market already expect from this company? Is big money flowing into the system or out of it? Where are the big institutions placing their bets? And what's the overall mood out there? Is everyone fearful or is everyone greedy? The answers to these questions, they're going to give you a much clearer picture.
Whew. Okay, so we've gone from auctions to expectations to the flow of global capital. Let's boil all of this down to its absolute simplest essence.
It's these three things: people, money, expectations. That's really it. It's not a company report card. It's the collective psychology of millions of people. It's the massive flow of money through the entire system. And it's the endless game of betting on what's going to happen tomorrow.
And that's really the final thought to leave you with. Every single price you see on your screen, it isn't a vote on a company's past performance. It is the sum total of millions and millions of bets on its future. Thanks so much for joining us for this explainer.